Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, nationally recognized retirement specialist and six-time author and fiduciary, Tony Walker.
Welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, fiduciary and retirement planning specialist, Tony Walker. And you're in for a real treat as we record this show in late May of 2024, because last week, in case you missed it, obviously you can go to youtube.com. That's youtube.com. Search Tony Walker Financial if you want to watch last week's show, because today we're recording Investments Part 2. And I know this sounds strange. The title of this show is How to Create, not a worry-free retirement, how to create a worrisome retirement. And before you get totally confused and turn off the channel because you think we're trying to intentionally create worry, I'm going to bring back in the studio for a second time my favorite nephew and financial fiduciary. Come on over, Mr. Wes Walker. Good morning again.
Good morning. How's it going?
It's going good. And again, appreciate you putting all this time in. Just to give the audience a little flavor for what we're doing, we're just going to do one show. Then we compiled so much information. Trey, who helps kind of outline some of these shows for us now, he even said, Tony, I don't think y'all are going to have time. So we just kind of backing off and doing two shows. Obviously, we got, Aaron and Derek have got so many clips they're working on and can drop in so many clips for us and doing a great job. So, folks, I hope you like this format. We would appreciate any feedback, but we're trying to keep this more loosey-goosey. One reason I'm doing this, we've had this show on over 500 episodes. I'm trying to introduce more people to you that work at Tony Walker Financial. And besides myself, and not counting Derek and Aaron, because they're technically in a different company, we have 19 full-time employees now at Tony Walker Financial. So I think it's about time that I start telling everybody what all these people do, because, every once in a while it kind of amazes me, the amount of work we can get done, and then people come in to see me, and they don't realize that, hey, I'm basically going to help solve the problems and lay out the plan, but you're going to need all these people. So before we get into the investments part 2 and how to create a worrisome retirement, speak to that a little bit, Wes. You've only been here a little over 4 years. The growth and then the vision we all have of trying to just stay ahead of that growth and make sure this service doesn't slip.
That's what's key. As opposed to other financial firms, I think you see a lot of advisors go out and hire more advisors because they want to bring in more business. They want to have more advisors to meet with more people. But then that same advisor is on a rollover call, and then he's doing 10 other different things. I think our idea is if we can meet with clients and speak with them by phone, be the ones that they talk to, and then have all these service staff in the background working kind of behind the scenes to make all these things that we've put into plans actually transpire, then we're going to be so much more efficient. And you've done a good job hiring that staff to make it possible.
Well, we've been very fortunate. We've had great people come on board. Yeah, Susan, my wife, it's funny. We hired 3 at one time. I've never done 3 staff at one time, but actually it was great. They've all worked out great. But she said, Tony, I just don't understand why you need all this staff. Well, ironically, Susan has some of her accounts, and we had to make some changes. And I kept bringing all this paperwork. And she said, what's this now? She was signing all this stuff. I said, Susan, this is why I need all this staff. You're just one client. We got over 3,000 clients, and look at all the paperwork just for this one transaction we had to do. And she's like, oh, okay, I think I'm understanding.
Yep.
Yeah. So folks, we are here to help. We're not going to leave nor forsake you. And one of my goals is to make sure, come heck or high water, and we're going to get into Charlie Munger here in a minute, come heck or high water, this place is going to stand the test of time. If I get to a point where I can't do this anymore, not retire, but can't do this anymore for physical reasons, or the Lord takes me home, hopefully we got people in place, and I think we're at that point now. We've got Heather that could take over. You and Trey can continue to see people. You're well-versed in the worry-free retirement. We've got all this service staff, so I'm really proud of where we are moving into the future and taking care of these clients.
I'd agree, yeah.
And with that said, I read an article the other day. I think 30 to 35% of advisors in the next 10 years will be retired. They're going to be out of the business. So folks, think about this. Retirement planning is not a one-shot deal. You could be working with an advisor 20, 30, 40 years. So hopefully they have plans to try to stay stay in business and not retire before you do.
Oh, yeah, or even sell out the practice and you're left with somebody who you didn't start with. Or,
That's right.
Yeah, a firm that doesn't share the same values.
We ought to get into that one day. I get propositioned all the time to sell this business, but it's just, it gets kind of ugly out there, all the people selling business and AUM and how much it's worth, and I'm thinking, there's no regard to the clients. You can tell. This is just a money grab, and I'm going to move over here. I'm going to get this. And it's like, what's the poor client's money? And it's just like they're part of this game of AUM. And I don't know. It's just, it gets kind of ugly if you ask me.
I agree, yeah.
Okay, so in the remaining time, if you're just now joining us, last week we spoke about Charlie Munger, the great personal sidekick of, maybe behind the scenes, one of the main reasons Berkshire Hathaway is so valuable to everyone. But tell us a little bit about his inversion theory real quick and why that led to our topic of how to create a worrisome retirement.
Mm-hmm. Yeah, just in brief terms, he was a weather forecaster during World War II, and he would basically, rather than thinking of how to get pilots back home safely, he would think of how he could most easily kill the pilots and then work backward from there. So the theory is invert the problem, work backward from the worst outcome to the best outcome rather than trying to start with the best outcome. And you just weed out all these things that could be potentially hazardous. So that's our idea with how to have a worrisome retirement is let's think of the things that would be most, kind of problematic to someone who is at or in retirement.
And don't you think that might be part of the problem? Every once in a while, I think people will come here, maybe they're with an advisor, they go back to a competitor who doesn't think like we do, and we almost look like outcasts or what's that Walker fella doing? And I didn't realize that's kind of what we're doing. So I'll use an example. We work with savers. Mm-hmm. You covered this last week, but if you were in the stock market, and that's fine, I guess, in the 401k, and you're getting close to retirement, it's worth a lot of money. But probably what you don't want to do, if you want to create worry, just keep it in the market. If you're a saver, you will worry because that thing eventually will go down. It always goes down. I know it comes back, but we're talking about retirement, folks. If that thing drops 20, 30, or 50% like it did in 08 and you're retired, I think you're going to have a problem.
And I think a lot of financial people think that most people have the same goal, so they don't differentiate between savers, investors, and speculators the way we have. They just see everyone with the same goal of trying to make the most money that they possibly can, and everyone is not built like that. A good quote from Buffett is that if you worry about the stock market on a week-to-week basis, a month-to-month basis, or even a year-to-year basis, you probably shouldn't own common stocks because you're not fit for it mentally. Yeah. So that's where I think we are really pretty well-versed in knowing someone's financial personality, drilling down to if they're a saver, we might not have any money in stocks.
That's right.
Just based on their personality alone. And if they have the asset base to support it, they may not need any money in the stock market. So it's a big deviation from where the financial world typically sits with their mentality of trying to grow at all costs.
Yeah, I've even made the mistake of not emphasizing to prospective clients who come here and we go through the game plan. And I'll say, now we're only going to assume 3% on the market long term. We hope it does better, but that's just an assumption. Because like that, we kind of want to assume worst case scenario.
Oh, yeah.
And then occasionally, I guess they talk to somebody and they're like, well, I don't know if we're going to do business with you or not. Why is that? Well, we can get 8 or 9% over here at Charlie's place. I'm thinking, yeah, that's not what we're trying to do here. Maybe we get 8 or 9% too, but let's test the plan out and see if it works at 3%. And then we can back in to whether you even want to take any risk.
And I'd hate to be at the other place promising 8 or 9%. And then, boy, I mean, you catch a year like 2022 or 2008 or 2001. I mean, you catch any of those years, that plan falls apart real quick. So I would say set your assumptions low, and then hopefully you can meet or exceed those, and it ends in a better experience for the client.
This falls into that Will Rogers, expect the worst and you'll never be disappointed.
Heavy.
All right, in our remaining time, you've nailed a few things last week, but how could we just intentionally create a worrisome retirement? What should savers do if they really want to create a lot of worry?
Yeah, we've gone through a few tips last week. Another one I had on here, just go at it alone. There's no sense in paying someone to help. I mean, that could get pretty scary too. I think a good differentiator is that when you're young, you may not need a financial advisor, speaking frankly.
Especially if you're saving money.
Yeah, if you're just putting money into a 401k or maybe a Roth IRA on the side, you have your life insurance, so forth, you probably don't need to pay somebody 1.25% or in our case 0.8% per year to manage your money. It's really about just stocking it away and letting it grow. When you get to retirement, though, there is a lot more problems that come up. So making sure that you're, not getting into higher tax brackets when you start taking money out of 401ks. When you get to this RMD age at 73 now, I mean, things start getting a little weird there, knowing how much to take out. when to draw Social Security, whether you should take money out of certain accounts or others. There are a ton of different problems that come up in retirement that probably should be handled by someone who is a professional. So I think that's a good tip.
About out of time here. Another tip you got for us?
Well, there's all sorts of things you can do in the younger years. If you start saving late, that's never a good idea if you're not putting any money away. So that's one thing we'll coach, younger clients, or I guess, our clients who have children, on how to save for retirement, where to put money in. We talked a little bit about last week, pensions. Yeah. They're gone. 401ks, you've got to contribute to those if you want to make it to retirement, then anything you can do outside of that. So
how to create a worrisome retirement in conclusion there is, especially young people, is just start saving. I know I've studied under a guy named Bob Castellone. He said if you'll start with 15%, set that aside, and then do that even when your income goes up, you'll have more money and you know what to do with. Oh, so that's good stuff, Wes. Aaron saying we got to take a quick break. We will be right back with more information, folks. Hang in there.
Hello there, Wes Walker with Tony Walker Financial. I'm Tony's nephew and one of the fiduciaries on staff, and wanted to take a moment with one question that I get asked quite frequently is, how much risk is in my 401k, or how much could this thing lose? One good thing to note is that a 401k plan is essentially just an investment vehicle. It doesn't really matter what vehicle it is. It could be a 401k, an IRA, a Roth IRA, a 457 plan, any of these vehicles. What matters is the cargo that goes inside the vehicles. So to determine how much risk is really within your 401k plan, it's important to know what you're invested in. Your plan administrator should be able to give you a document that shows what your asset allocation mix is, how much you have in stocks versus how much you have in bonds. And then someone like Tony Walker Financial, a fiduciary, would be able to determine if that's suitable for your risk tolerance as well as your stage in the game, particularly if you're drawing close to retirement. Keep that in mind as you're getting toward retirement, and be sure to consult with somebody who is a fiduciary that might help you understand exactly what's in your 401k plan.
Did you realize that if you have more than $250,000 in retirement assets, the government could tax as much as 40% of it when you go to take it out? And with current tax rates set to expire in 2025, the taxes you will owe on your 401k could climb even higher. Don't wait until 2025 to see how much Uncle Sam will take of your money. Get a game plan by logging on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Recently, an 80-year-old widow, along with all of her adult children, came into our offices to review her situation and get a second opinion from myself. When I asked what brought them in to see me, she had mentioned that her husband had recently passed away. And the problem was getting everything organized so that they could understand what she was going to do with all this money. You see, he had made the mistake a lot of people make. He was very good at investing, and he took control of the household finances, and he thought it was best to spread out everything all over God's creation because he'd always been taught you never want to have all your things in one basket, which is true. But he also forgot to realize that you have to have everything under one roof. And this is why this widow was panicking. So our goal, our job was to bring all of this in to Tony Walker Financial because we can handle it all. And that way, now when she passes away, it's going to happen. When she passes away, her adult children are going to know exactly what she's got and exactly how those assets are going to pass. Plus, we're going to be able to eliminate a lot of duplication of accounts that her husband tried to create with all these different financial institutions. So let's take a look at the one roof philosophy. And again, remember, this show is dedicated to savers. We are not working with investors and speculators. We're working with clients who are more concerned with the return of their money than on it. Somebody that wants a retirement planning firm to take care of everything, handle everything. That's why we call it the worry-free retirement process. Now, in general, this is general, these are the four main products that we might use for our clients. And in general, these are the safest products one can use. Remember, we're not out here trying to grow your money at all costs. We're trying to use and enjoy this money at the least amount of cost before it's too late. So let's take a look at the first one over there. These are bank products. And yes, through Tony Walker Financial, through our Charles Schwab platform, believe it or not, we can get bank products through Charles Schwab. Now, what are those main bank products we use for our clients? Well, those would be, number one, certificates of deposit, as well as money market accounts. Now, we might use money market accounts in situations where people say, hey, Tony, I've got $100,000, but I want to keep this liquid because, maybe I've got a house I'm going to be buying or remodeling, or kids might need it, or whatever that is. We can use the money market accounts. Somebody might say, well, I want it safe and I want a good interest rate, and I don't mind tying up the money for a year or two, but I want it safe. Well, there we might use a certificate of deposit, and we'll shop those all over God's creation also through Schwab, because we can get a multitude of CDs through different banks. So those products we can get. The number two safe product, government bonds. Now, bonds haven't done as well because interest rates have spiked, but over time, usually government bonds do great. And of course, they're backed by the full faith of the U.S. government. So in general, government bonds are very, very safe when we use those religiously within the process. Number three, I love these. These are insurance contracts, namely annuities, and we only use fixed annuities. We do not use variable annuities. And also, believe it or not, life insurance contracts, and in some cases, long-term care insurance contracts. So again, annuities, life insurance, and long-term care, they're actually contracts. They're not investments, and that's why we like those types of products, because the insurance company issuing those contracts is backing them to make sure that they are paid to our clients when they need the money. And then the fourth type, this can get a little more risky, but generally these are dividend-oriented ETFs, which stands for exchange-traded funds. Now these are very, very low cost. Again, we get these through Charles Schwab, and again, you can lose some money with these, but over time, these have proved to be fairly safe. In the long run, they make pretty good money, and they pay a dividend in most cases, meaning even though you're not taking the principal, they're paying out dividends, kind of like interest, to our clients. So these are the four types of products we use at Tony Walker Financial. We would be happy to go over these products at any time with you to see how they would fit within your situation. So it's interesting that I created this graphic here, and this helps explain the difference between safety and risk. You see, with the worry-free retirement process, we're okay with both, but most of our clients who are savers would rather have more safety of principal than taking a lot of risk. So let's go over to the whiteboard. I'm going to break this down and tie this into our philosophy of keeping your money safe, and also how our income software reflects that. Let's take a look at that right now. So it's interesting as we think about this idea of risk and safety and the four main products we use for safekeeping of our clients' money, kind of draw a dividing line here. These really are two different worlds. There's a world of safety, which is really protection of principal. That's the guaranteed world. And then risk, which is really meant for growth, which is creating uncertainty. The money can go up, it can go down. That would be growth. Now, of the four products we use a lot, actually on the safe side would be the bank products that we offer. There would be the insurance contracts, and of course the government bonds. Okay, they would fall on this side. Now, of the risk, remember the four products, actually the dividend-oriented ETFs would go over here. Also, stocks would go over here, which we can offer through Charles Schwab. Other more risky ETFs, and then even long-term bonds would go over here. These would be the main products we also offer at Tony Walker Financial. So as you can see, we're well-versed in all these products. We're more than just annuities. I know a lot of people out there know that we're known around the country for our prowess, if you will, in annuities. But we've got over 2,400 accounts with Charles Schwab. That would be on this side over here, plus the bank products, with over $260 million that is non-annuities. So folks, it doesn't really matter to us. We're going to work the game plan, assuming you're a saver, and set these products up. So, but I like to ask this question, though, and this really helps me understand the mind of a saver. If I've got somebody that says, Tony, I want no risk, versus somebody that says I might want some risk. This is a page out of our income planning software that we share with all of our prospective clients who are looking to work with us. Notice long term, even though this could be in a Schwab account, we're only assuming a growth rate of 3%. So my question to people is, Mr. Jones or Mrs. Jones, if all we could earn you is 3% long term on your money, that's all we could earn you. Well, hopefully it'll be more, but let's just stay with that. But you could sleep better at night, something we call
sleep insurance.
Then what would you want all of your money over here or some of it over there? If somebody says, oh, wait a minute, if you could earn me 3% and that would accomplish all my goals and objectives, well, shoot, just keep it all over there and keep it safe, Tony. I don't even want to take a chance on any growth. But then another person might look at that and say, well, Yeah, I'm okay with that, Tony, but I'm okay having some of my money over here, maybe 20 to 40%, and maybe only 60 to 80 over here. We can do that. Again, the more potential growth you have, you're going to have to come over here to get it versus the more safety. And that's the beauty of designing an income plan around your personal needs. Folks, we've done this for years. In fact, I've overseen more than 5,000 written game plans. We know this world very well. If you're a saver, here's what I would suggest you do right now. Log on to TonyWalkerFinancial.com. There's lots of resources on there. But one of the things you might want to do is order this particular book called The Worry-Free Retirement Process. This book will go into great detail of exactly how these different products work and then help you get a better understanding of which products might be right for you and your situation. So do it now. Log on to TonyWalkerFinancial.com, or if we can be of any help and the internet's not your thing, just call us at 877-499-9255. Wondering how much money you'll need to retire? Probably a lot less than you think. I'm retirement specialist Tony Walker, and for the past 36 years, I've helped thousands of savers determine when to retire and how much money they'll need in retirement, and I can help you too. So if you're retired or thinking of retiring soon, maybe you know of somebody who doesn't know if they can retire, let me invite you to log on right now to TonyWalkerFinancial.com. We look forward to talking with you soon. Having worked in the retirement planning field for 40 years, I know it's not just about how much money you've saved for retirement, but making sure you one day don't run out of money. That's where mailbox money comes in.
Mailbox money.
A reliable, lifelong income, much like the pension plans from the past. If you're interested in turning your 401k into mailbox money, let's talk. Just set up your free 10-minute phone call with myself at TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. One of the things we're known for here at Tony Walker Financial is our proprietary 401k rollover concept called the Worry-Free Split IRA. And here's how it works. Unlike most money managers and wealth managers who tend to work with investors and speculators, their job is to try as best they can to grow your money with little concern for costs, fees, and risk. On the other hand, our split IRA concept recognizes the fact that savers do not wish to put all of their money at risk, but maintain a balance between enjoying the possibility of some stock market gains, but also without the fear of running out of money in the future. In order to accomplish this, our split IRA works as follows. Let's start with the first bucket. We refer to this as the immediate income and liquidity bucket through our current custodian, Charles Schwab. In this bucket may be all or some of your 401k plan depending on your level of risk. After we determine how much of your 401k or IRA we wish to keep liquid, we then will analyze your level of risk and select one of our 5 personally managed investment portfolios for you. Of course, should you decide to change investments to another portfolio over time, we will be happy to do so, and usually at no additional cost to you. Then we turn to the protection bucket. This is the bucket, or sometimes buckets, where the annuity will go. Why do we put the annuity or annuities in the second bucket? Because we're assuming any growth we might have would be in the Charles Schwab bucket. The annuity, fixed annuities, fixed indexed annuities, fixed interest annuities are meant for protection, and most importantly, their goal is to help you not run out of money. You see, an annuity is the only contractually guaranteed investment that can do this. Wall Street products can't do that, and neither can the products that we place with Charles Schwab. Only annuities issued by insurance companies can provide guaranteed income you can never outlive, something I call mailbox money. So if you are a saver, someone who is more concerned with the return of your money than on it, maybe you have a 401k at a previous employer. You might be over the age of 59 and a half and didn't realize you could even roll your 401k over to someone like us. Maybe you're just ready to use and enjoy this money that you've worked all your life to accumulate. If that's you, let's talk. All you got to do is log on right now to TonyWalkerFinancial.com and click on that Let's Get Started button.
We can either meet in person or we can take advantage of something that's absolutely free. We call it the free 10-minute fiduciary phone call, whereby you can talk to myself or one of our other well-trained fiduciaries to first find out what it is you have going on and how we might be able to help you. So take advantage of that now. Log on to TonyWalkerFinancial.com and let's get started.
Welcome back to the Worry-Free Retirement. In case you're just now joining us, I'm with my favorite nephew and fellow fiduciary, Wes Walker. We got a few more minutes, Wes. I wanted to cover these tips, and if you're getting ready to probably get thrown off if you're just now tuning in. Obviously, this is the Worry-Free Retirement Show, all right? But we're imagining somebody does not want any help. Maybe they're going to go it alone. They're going to do what they've always done. And we're saying when you get to retirement, here are the things you can do to actually create a worrisome retirement. I think you got a couple of more tips.
Yeah. Another good one is if you didn't have a big emergency fund in retirement, that's probably a problem. I mean, you want to have a lot of cash on hand.
Yeah, explain cash on hand and what that might even look like. How much?
Yeah, I mean, there's plenty of rules of thumb and calculators out there. 3 to 6 months of expenses is thrown around a lot. But, I would just say that any amount of money to have in cash is probably appropriate so that it would cover any big expenditures. Mm-hmm. Roof goes out, you need a new water heater, the kid's in jail, something crazy goes on. You want to have some cash handy. And I just mean in maybe a high-yield savings account or a money market fund just sitting there in case you need it. A lot of people will go into retirement putting every single dollar that they have into retirement accounts and to investments, whereas it may be illiquid or hard to get that money out, or it may have a downturn in the market and it's costly to get it out. So,
and you got taxes.
Oh, yeah.
The biggest thing we've been doing lately, and people they're really almost dumbfounded sometimes. They'll get in retirement. Maybe they don't need a lot of money right now, and I go, wait a minute, you only have $5,000 in the bank after tax. Everything they have is pre-tax. Mm-hmm. And they're like, well, what's wrong with that? Well, because you're in a pretty high tax bracket. Maybe they're still working a little bit. And I might say, let's do this. Let's intentionally pull out some money. We'll go up to the 12% bracket. These are services, folks, we offer at no additional charge. And they're like, well, what are we going to do with the money? Bank it.
Yep.
Just bank it. I mean, you think years ago, I've been doing this 40 years now, June, 40 years I've been in this business. 20 years ago, if somebody had come into me with $20,000 in the bank, we would have been scrambling to invest it. $20,000 in the bank right now of after-tax money is not a lot of money.
No.
So that's a great one. All right, another tip I've seen over my shoulder here. This is a really good one.
Yeah, so relying on Social Security entirely for your retirement income, that's a scary proposition too. So it goes back to, maybe you haven't saved as much for retirement, or you're counting on it to be, kind of your main source of income. Don't have any doubts about Social Security. I'm sure for the foreseeable future it'll stay funded. But I mean, there is some worry that in the future it may not be what it's been in the past.
And back to one of your tips you gave on not having an advisor and going it alone, what people are shocked sometimes, where I'll kind of use the example, if we're going to play dead, the couple's like, what do you mean? Well, we're going to imagine one of you are deceased, and let's just see what happens to this income. Inevitably, most people aren't aware that when one spouse dies, one of those Social Securities, the lowest of the two, goes away. And then if you have a pension on top of that with a survivor benefit, I mean, we've seen cases where if, let's say, one of the persons dies, they're down $3,000 to $4,000 a month of income, and they're like shocked. They hadn't thought about that.
Especially, and if you have no permanent life insurance in place, if there's nothing that's backing up those cash flows, if you were going to receive that $4,000 a month, and there's no lump sum that comes at death, I mean, it starts to get a little scary.
Yeah,
and I mean, you've lost a loved one. It's a hard thing to go through. So to add fuel to the fire of worry after you've lost someone you love, that can be pretty scary, to be totally reliant on that Social Security and maybe their pension when it's not going to be there for the foreseeable future.
Well, folks, that's why you need a game plan. And at Tony Walker Financial, we are happy to try to help you. So why don't you do that? If you're sitting there right now and some of these tips are creating worry and you want to be worry-free in retirement, we can help you with that. We've been doing this for years. We have over 3,000 clients. We can meet with you in person if it warrants at either our Bowling Green, Louisville, or Lexington, Kentucky offices. So take advantage of talking to me, the owner of the company, Tony Walker, with a free phone call by logging on to TonyWalkerFinancial.com, TonyWalkerFinancial.com. You're going to click on that little red button. We'll arrange that meeting over the phone. And again, if it warrants, we will meet in person at no obligation, no cost at Bowling Green, Louisville, or Lexington. And Wes, appreciate you being on the show so much. We've had a lot of fun.
Yeah, been a blast. Thanks for having me.
You're welcome. Well, that's all the time we have today. But you remember, between now and next week, if all else fails, you be worry-free and make it a good day.